TradeTheNBI.com. This is John. This report is for the 6th of February. Well, a little bit of softness bringing us back down to the 76%. Not a hugely significant move, but what we are getting closer to is, we've got all this government data that comes out that's presenting, this somewhat rosy picture. Then you have the contradictory data of, manufacturing and housing presenting a diametrically opposed view. At some point very soon, probably by spring, um, we're going to know which one has been fudging and or misleading. And up to this point, the market's been suggesting that it's all to the positive side and that all the naysayers are wrong. However, you're starting to see ripples everywhere. That maybe not all is well as they say it is. And so we'll have to continue playing that out. And obviously, earnings are going to start to reflect that because you're not going to be able to hide. The consumer being tapped out or squeezed significantly. We'll also be watching, bank stocks and that, and whether or not credit card defaults, because they're setting aside some pretty big reserves for what are supposed to be fantastic times, which is always interesting to see. Nasdaq moving back down towards that 1247. We've still got magenta and yellow above 33. No activity from the NBI white whatsoever. Still cyan under red. So as much as there's some negatives and positive extremes to fill back, nothing catastrophic from that setup down. You can still get a drop of quite a few points and still be within that overall range. So it's by no means a panacea to just ignore everything. It's just saying that, hey, there's still some significant support underneath everything. Treasury is finally giving back a little bit because at the end of the day, people are starting to realize that the Fed's not going to stop. So you keep rising, and the Fed keeps raising rates, which means the yield was actually going down, even though rates are going higher. It's a complete disconnect from the real world. It's one of the most unique times to be watching financials, to see this kind of abstract dislocation between things that are integrally linked, and to have them separate as they are is not uncommon. You'll have dysfunctional, moments, but for this duration and this extreme, it's going to be quite the confluence when everything starts to actually come together. Oil dipping back down to 74, so that's going to present some relief significantly. So, literally needs to break that 70 number though and start to get into a normalized realm. The cold that the Northeast has had supposedly coming this way towards Europe. We'll see if it gets here. And the temperature is supposed to drop here in the next couple of days, but um, still seasonably fine. I mean, lows in just below 30 and highs in the 50s. So I wouldn't call it bad. In fact, we still have green grass and everything growing all throughout the winter so far. So Europe was saved by that with the fuel shortages, but we'll see further north that causes more problems. Gold really getting punished off of some of this, ironically, for no good reason. But when does that ever stop gold from being attacked? We had some positive extremes going all the way back over to here. So that would leave further room for it to drop still before filling that in. Um, Still doesn't change the prospects for gold, except for that's the market saying that they think that inflation is going to end and you're going to get a deflationary cycle. So that would be counter to everything else that has been reported. Even if you're talking about the slowing of inflation, as far as that, doesn't change the fact that we've already had it and everything's already elevated and they're not going back down unless you have a real crisis with the economy, and that would not be great. And some have recognized, like in Germany and places like that, the ability to produce anything is becoming much more difficult as those energy prices that have skyrocketed, natural gas, everything else that they need to run their plants, has made everything virtually so expensive to produce that most aren't even doing it. And so it's just serious eurozone problems and a little bit of a pullback. I mean, this is a tiny relative, but it erases the last 2 weeks of movement in a day plus. So that's how quickly, easy come, easy go. But that's how fast that distribution back to the norm can take place. We've always talked about markets falling 66% faster than they rise. Remains true to even this day. So, from a Bitcoin standpoint, right back to the support levels. Remember, we talked about this all positive extremes. So, this test was necessary. However, look at that, still strong. It's just excessive from a DOC standpoint, and it can't sustain itself at those levels indefinitely. It can do it for a while. Markets can be, as people describe, overbought or oversold, but they're not really overbought or oversold as much as there's still continued demand and people haven't gotten scared enough. It's when that fear hits is when everything changes, and we know how that works. And of course, TraceStation, even though Italy had its internet interruption, TraceStation still continues to do these random updates on me over the weekends. I've changed all the settings multiple times, and it just loves to do them on Sundays for some reason. When I've asked to change it to Fridays, do it monthly, it just ignores it. So it's sort of a random thought wave, but that's neither here nor there. What we do have, though, is what's in front of us, and we're going to start to see the market face some more significant challenges here going forward. But as always, trade well. Look for me in the Skype chat. Have a good one.